I am really pleased that Heidi and Women in Housing and Finance have decided to join us as a sponsor this year. I've been in this field in a long time, and Women in Housing Finance has been a phenomenal organization. If you're in the DC area, they have great programs, and they were terrific in promoting our program. And I should make the disclaimer that men can belong to Women in Housing Finance. They are welcome to pay the membership dues and to attend. And Sam Ozek was the president.
We've had a male president and male board members. We're glad to welcome all.
So it's a terrific organization and gives all kinds of perspectives. And we are really, really pleased to partner with them. Heidi and I, before I retired, had opportunities to work together, and she's a super lawyer, and I'm really, really glad to be co-chairing this panel with her. Oh, good, everybody's here. This is terrific. So this panel will build, I think, on so many things that we heard today. There was a discussion of skinny master accounts. You know, that's going to be one of the topics we talk about. And this whole question about who's inside the perimeter and who's outside is really an element of this. And we have, with the new administration, a different approach, I think, to fintechs, crypto, all kinds of things that are now up in the air, and a lot of revisiting of what happened in the prior administration. So we really have a lot of things that people are going to look at, and certainly the people on the banking side are very interested in what the fintech people are looking to do, and the fintech people, I think, are concerned maybe about Tom's thing about catching, the dog catching the car. And yes, this is an opportunity here, but and Michele is going to, I'm sure, have lots of thoughts about that as a former OCC person, because she knows where the car is. So it's going to be, I think, a great program. So our panel is Michele Alt, who is co-founder and managing director of Klaros Group, and that is a very hot, non-legal operation. Is an advisory group and is all over.
It is illegal. It's a non-legal.
No. I wasn't saying that. Okay. Well, in any event, Michele is here, and really glad to have her again this year. Angelena Bradfield is the head of policy at the Financial Technology Association, which is a fintech group here in town. And Caitlin Long, who's on the screen with us, very glad to see her. Caitlin is always in the news. She is the founder and CEO of Custodia Bank and has had any number of tussles and tangles with various governmental entities, including one starting with an F. And so we'll look forward to any part of that she wants to share with us. And Ian Moloney is Chief Policy Officer at the American Fintech Council. And Angelena and Ian, you're next to each other, so hopefully there'll be a good back and forth. So with that, Heidi, it's a pleasure to turn it over to you.
Thanks so much, Bob, for those kind introductions. The first question is for Michele. And Michele, after years of regulatory paralysis, why do you think the floodgates have opened so much for new bank charters from fintech companies? How much of that do you think is a reaction to technological competition or progress, and how much to politics?
I'd go 90% politics and 10% scale. The reason the floodgates have opened is that during the Biden administration, there was a 0% risk tolerance to bank failures. And, Mike Sue is going to stop showing up to events where he knows I am, because I always call on him. And he's been very frank to say, and I appreciate this, that when he was heroically helming the OCC, there was pressure on him politically to both charter new banks and accept no risk of failure. And those are inconsistent objectives. And so, it's and then along comes the Trump administration, and I mean, we all remember the photo of the big tech guys on the inauguration platform, right? It was clearly, there's a new game going on, and it's much more tech-friendly. It's much more crypto-friendly. And there has, at the same time, been a pent-up demand for FinTechs to get into the banking system. And over the years, a lot of them have reached a pretty significant scale. So the burdens of becoming a bank make sense for a number of them.
Thanks, Michele. So I'm going to have to throw a curveball question. We've been talking a lot about FinTechs here, but what about the mixing of banking and commerce? There had been the moratorium, years ago. Walmart had tried to get a charter. Oh, is this a little better? Okay, perfect. I'll be very careful not to breathe too heavily on it. Anyway, in terms of taking it kind of the next step in terms of chartering of organizations, do you think we'll see an erosion, let me put it a different way, of the division between banking and commerce? Are we seeing that slippery slope, kind of go down the hill?
I love a curveball. Just a sec. Got it. So that is like saying in the financial regulatory world, are you against apple pie, right? Like the mixing of banking and commerce is such a boogeyman, right? But anytime somebody brings it up and Walmart gets everybody's, knickers in a twist, and I say, who is asking the question? Not you, Heidi. But generally, when you hear, and Yelena was great on the quick detour into ILC land during her remarks, but anytime you hear that argument, like, oh no, mixing of banking and commerce and Walmart, and the next thing you know, it's going to be Google, and I just say, who's raising that argument? And usually it's the incumbents, and I haven't forgotten, and maybe you guys haven't either, but along about 2017, Jamie Dimon said banks should be scared shitless of FinTech. And then he stopped saying that during the Biden administration. Well, we're in a new day, and the competitive playing field is fierce. So it's a matter of, it's competition. It's less about the banking and commerce third rail, I think. But
and Ian,
back to you.
Got it. Ian, what do you think are the main drivers in these discussions behind charter discussions for innovative companies and?
Yeah, I mean, innovative banks and fintech companies, because I think the charter question really does kind of hit both of them a little bit differently, but obviously, there's a lot of engagement from both. As far as drivers, I think, Michele, like you said, a lot of market drivers, sort of a no-duh as far as the regulatory side. So those are the two main factors. But digging a little bit deeper, I think there's, just kind of referencing the FDIC chairman in some previous statements, he said, 412 banks entities received de novo charters in 1984. You have 97 between 1995 and 2007, and then 86 de novos from 07 to 2025. In a financial services industry that likes the robustness, competitiveness, this does not seem like, competitive numbers. And so there's, to Michele's point, I think there's a lot of pent-up demand. Then, kind of disagreeing a little bit with a previous panelist that talked about how FinTechs, their modus operandi or their culture is to just break things and then apologize after. I think that that's like an antiquated way of seeing how fintechs are operating in this space. Yes, there's still new entrants every day, and there's hundreds of different fintech companies that are coming to the fore, particularly in places like AI. But a lot of the ones that are applying for these bank charters, they've been around for quite a while. They have matured. They have also operated very successfully in bank fintech partnerships, which crucially there is a significant compliance piece. And so that compliance regime actually does matter when you're going through the whole bank chartering process and thinking about that. And so ultimately, I think that's something to take into account as far as a market regulatory driven consideration. But then there's also more of the straight regulatory considerations. And so I think about really twofold. At the state side, we've seen things like true lender tests come up at state-by-state frameworks. We've also seen DIDMCA opt-outs, and for those that might not be familiar, that the piece of DIDMCA that matters for us is the rate exportation part, not the monetary policy piece. But ultimately, those sort of regulatory considerations have pushed not only fintechs to thinking about, where they should go as far as being able to engage effectively in their business model, but also state charter banks versus, being a nationally chartered bank. And so, it's not surprising that a couple of years ago, I was speaking with several outside counsels, and they consistently told me, and this is what I told, our members too, is that it's an uphill battle to be a state chartered bank right now, and so maybe look at the national charter, because that could be a better option. And that's not to say that we want to have people charter shopping for regulatory purposes, but it gets into, I think, the federal piece, which is there are leaders and laggers within the federal landscape as it relates to examinations and as it relates to understanding innovation. And so finding the regulator that understands and that can actually have a good approach towards a business model, I think is a really functional path forward.
Hi. We got an email. It wasn't even to us. It was to Farish copying us from that insurance
We're
company.
hearing a competing
Declaring
voice
the car
here.
a total loss.
Michelle, I have one for you. This
Let me
is
walk
it's
outside.
not on the script.
Declare.
Okay, so let me just do a duet with this guy. Okay, go.
They needed to contact us to pick up
So,
their personal
JP,
items.
I think you're on the audio somehow or other.
Somebody's getting hot mic'd.
Okay, great. So, Michelle, there was a conversation about dogs and cars and catching same. And Ian just portrayed FinTechs as very prim and proper now and all grown up. So that's interesting, because I used to walk into them and they had a foosball table and they had a beer keg set up, at 4 o'clock in the afternoon. So a little bit different than your typical bank environment that I'm used to dealing with. But
I mean, I think there's yes and no. Like there's banks that you can think of that probably go to the bar to have those beers and play the foosball table there at 3 p.m.
okay, fair enough. I mean, I actually thought it was pretty cool. But
where
so
are you
Michelle, here's the question.
Are you still on the
Since
phone?
you've been on both
Are you still
sides
on
of
the phone
this
with them, or
thing,
no?
the mentality to be a regulated entity,
I'm gonna call
and all the restrictions and all the overlooking that you get versus the freedom to be outside of that, that is a big thing to jump across, which I think until you've seen both sides, it's a little hard to appreciate. In the S&L industry, a bunch of real estate developers said, wow, we can get all the money we want and we can use it for our own projects in Texas and it's going to be great. And it actually didn't turn out that way. So whatever reaction you have to this question, or maybe people in the room who would be interested in getting that a little bit of that atmosphere and vibe.
Yeah, so I think your question, Bob, is really about cultural fit, cultural alignment between fintech and banking. And for a long time, never the twain shall meet on those two, But there are great reasons to become a bank, as we all know. And, there's access to low-cost funding, there's the Fed payment rails, there's membership in Visa and MasterCard, and so on and so forth, master account, theoretically, Caitlin. For a long time, when I would get clients who would be like, well, gee, if we become a bank, are we going to have restrictions on our growth? Yes. Are we going to have different multiples? Probably. My answer would be like, these are important questions, but you should be so lucky if that's like your only concern, because if you can get a charter, it's incredibly advantageous to you in most instances. And so I'm getting that cultural fit question a lot less these days. Like people have their eyes on the prize and they're ready to make some adjustments. But and maybe we can get to this later, some people have talked about it. The question is going to be, and Yelena mentioned this, I think, and Sarah Jane too, is, how many of them are actually going to go from conditional approval to actually operating as banks? That there's still quite a bit of runway for these guys.
Thank you. Ian, as a trade association that represents a significant number of banks and fintechs, how are you viewing the recent increase in chartering activity by fintech companies? And will you keep those people as members if they become banks? I think it's quite important.
Yeah, I think we have about 150 or so members, a little north of that, and 20% of those are banks. And so you could naturally see that this might be a tricky conversation that we have around the water cooler, around the working group meetings and whatnot. But I think, firstly, there's sort of something that Michele touched on as far as that relationship aspect. I think that's actually, as some of these, flashier names or larger fintech companies are considering chartering or going down that application route, it's similar to me as thinking about it from like an economics term of like, you've got job displacement. And ultimately, yes, there will be sort of winners and losers within any job displacement. Similarly, there will be winners and losers within sort of the bank fintech partnership space. But ultimately, anywhere that job displacement goes, there's new opportunities. And so I think there will be new opportunities for banks and fintechs to work together. And so thinking about, some of those that are going after charters that are more in the lending space, there you have an opportunity to continue to leverage the bank relationship that you previously built, since there's not just on the consumer side is our industry built on trust, but also on the actual business to business side, there's a lot of trust and a lot of relationship building that goes along with that. And so, you'll see opportunities for, maybe that fintech company that was partnered for lending purposes to facilitate lending. Well, now they've got a purchaser on the secondary market of their whole loans or their securitized loans. And so there will be opportunities like that. It doesn't mean that the partnership ends, it just changes in dynamic. And so there's really some of that quality. But ultimately, I think there's still some concern, rightly so, from some banks, but I think that's more of like a traditional bank concern, as opposed to the innovative banks who we count as members that have really heavily invested in technology, have engaged, through the sponsor bank land of being able to access national consumer groups. And from that, being able to now have new opportunities for new fintech companies, because there's, as I mentioned, there's hundreds of, and thousands of fintech companies kind of starting up and figuring themselves out. And so I don't really see it as like, necessarily the end to a bank fintech partnership or anything, doom and gloom. I think it'll just naturally change. And the last thing I'll say is that there's a lot of fintech companies that will never pursue a bank charter because it's not in their core competencies. It's not what they're in the business for. And so they will always rely on banks to do that sort of work.
Super, thanks. Angelena, how do your members view the opportunities posed by trust charters and the emerging skinny master accounts, given their current reliance in working with banks through partnerships?
So from an FTA perspective, I would say a majority of our members, just for references, I know FinTech is in both our and AFC's name, so let me delineate that very quickly. A majority of our members are more on the traditional FinTech side. So we have a very small number that are chartered banking entities, though I will say that number is going to double, potentially, based on the number of applications from our members that are in with the various banking agencies right now, including a couple for full national bank charters. So, I think from that perspective, again, just echoing a little bit of what we've heard previously, a lot of this is based on the business and market decisioning that they're making. But, from our members' perspective, I think they've been very pleased to see this opening of sort of the application process around chartering. In particular, they welcomed both the OCC's trust, national banking charter trust changes, as well as the Fed's skinny master proposal. I would say, many of these entities, particularly those focused on the Fed skinny master proposal, are focused predominantly in the payments industry. And so I think that while they saw the proposal as a good first step, I think there are areas particularly, and I know we'll get into this in the conversation as we go on, there are areas for improvement, particularly around access to Fed ACH. One, because it has some unique attributes that are important to payments that only really sort of ACH allows. Two, of course, it has the largest volume of any of the rails out there, and so it's an important part of the ecosystem.
Thank you.
And I guess, Caitlin, I'd be interested in your take on all of this, too, from the bank perspective. We're kind of approaching it here from more of the private sector perspective, non-bank side.
Right,
Okay.
and can you hear me? Can you hear me? Okay, good. Sorry, thank you. Sorry to not be in the room with you. What's interesting is that the Wyoming Special Purpose Depository Institution Charter is a full-fledged bank charter, and the Wyoming Speedy Banks are examined under bank examination manuals and have full-scope bank exams and CAMEL scores. So I think a lot of folks were surprised at the Kraken announcement, and I didn't see any analysis that picked that up. This is a bank that's been examined under full-fledged, full-scope bank examinations with the FFIEC exam manual and has had multiple CAMEL scores through its cycle assigned. So that's the question is, does that distinction matter, right? When a FinTech goes and gets an actual depository institution charter as opposed to a trust company charter. Big difference. I think there's some interesting things evolving, and it'll be interesting to see whether the states step up. They're pretty angry, of course, about what's going on with the OCC trust charters right now. And I've heard scuttlebutt, but nothing's happened yet about really pushing back over the reinterpretation of the statute on allowing trust companies to de facto become depository institutions with a small fraction of the Tier 1 capital requirement of a depository institution. Anybody who's really interested in looking at what that might look like, you should pull up Anchorage's 3Q and 4Q call reports and put them side by side. And you'll see something interesting. I will give you a preview. Have you ever seen a financial institution whose Tier 1 leverage ratio was 96% at the beginning of a quarter and dropped to 5.96% at the end of the quarter? And when you see the average assets, it went from 80 million at the end of Q3 to 1.4 billion average for the quarter, but 840 million at quarter end. I'll let you figure out the implications of all of that, all of those facts. But I know that there are a lot of folks looking at that right now.
Interesting, very interesting. Ian, just to draw this out, something you were saying a little bit more, is this trend towards seeking bank or trust charters, do you think, purely a market play within the various subsectors of the financial services industry, or do you think there are policy and compliance components as well?
Yeah, I mean, I think just kind of, touching on some of the points that I mentioned before, there's certainly both considerations in
Right.
play, and sort of that interconnectedness. Any good political economist will say naturally regulatory changes are going to impact markets and vice versa, and so there will be kind of adjustments and movements there. I think ultimately, our view is that for any entity that wants to get a charter or wants to change charters, that ultimately it should be more of a business decision than any sort of regulatory decision. And for those that are seeking to get a de novo charter, that they're really thinking long and hard about what this means. I think Michele, and kind of the analogy of the dog catching the car, that's very true. And there is something to be said about the level that of scrutiny that you will get as a chartered financial institution and the privileges that you get as well. But ultimately, I think there needs to be sort of that focus that any fintech company that's looking to get a charter is going to operate in a safe and sound manner, is going to abide by the rules and see the charter for what it is, which is a privilege.
Yeah, I think that's well said. Angelena, in terms of, and Michele, we've talked about the dog catching the car, but in terms of where we're going from here and how the chartering discussion evolves in future years, how do you see that, kind of trajectory going in terms of the trends? Do you think we'll continue to see this uptick, plateau, waves and valleys? How are you thinking of it?
So in an effort to introduce maybe another concept that we haven't talked a lot about, I think there's been a lot of discussion today about the fact that many of the charters are conditional, that there is a short runway in this kind of current environment, and we'll see sort of what happens with there. I do think the one other thing, and I will say this as a purely academic comment maybe, and less of I have some inside information that I'm not sharing comment, that we haven't talked about is, what is that sort of decision on seeking a charter versus maybe purchasing one? And sort of, what does that do given some of these timeframes in the business decision that maybe entities are making right now as they're looking at that runway? I think ultimately, everybody in this room has a general sense of what happens next, right? We see what happens in the next couple of years, then, perhaps there's some sort of sea change, and then we'll have a bit of a halt for a while. So I think not only sort of in this space, but I think broadly in the sort of bank merger and acquisition space, we're seeing a lot of activity, predominantly because of the opportunities that we have right now.
Okay, so here's the deal. A little bit of free advice for everybody who's thinking about this. You really have until September of this year to file a de novo charter. That's because you have once you file 4 months for regulatory review, if all goes well, and then you have a maximum of 18 months to open your doors after that. So conditional approval. Then 12 months later, you have to fully capitalize the bank for the first 3 years. I see people taking notes. Okay, so you need to fully capitalize the bank 12 months after preliminary conditional approval. 6 months later, you must open your doors. You can go faster. You can't really go slower. So if you're just keeping track of where we are, I know it feels like year 200 of the second Trump administration, but if you're just thinking backward from the next inauguration, you need to have filed your de novo by about September. The race is on. I think there are so my expectation is, things will get a lot slower in de novo. The work that will then pick up a lot is acquisitions. So if you're not quite ready by September, be thinking about acquisition. The acquisition review, there's more work up front. You got to find somebody to marry, you gotta, do your due diligence and start making a plan for emerging operations. But the application and the review is essentially the same length of time, and at the end of it, you have an operating bank. So there's still time even after September.
And I think just quickly to connect some of the dots, I think, between Michelle, what you're saying, and Angelena, what you're saying about purchasing a bank, and then going back to your earlier point around, banks that, like the whole idea of, are we letting risk into the system? Are we letting banks fail? Like, is this kind of a market that moves and flows? Or are we trying to stop any bank failures? I think that's something to consider too. Is how is the next administration even going to think about chartering, and about is there going to be that sort of, this can be an efficient market or somewhat similar, some semblance of efficiency, and the allowance from the examiner level to let a bank fail?
So here's the deal. The risk exists regardless of whether it is through a chartered bank or not, right? Not having a charter doesn't mean you're not able to operate. You just have to do so, in partnership with the bank or through, a patchwork of individual state licenses. They are here. FinTechs are here. They offer products. That risk exists, right? So, anytime people go, oh, you're letting risk into the banking system, as a former regulator, I'm like, great. I trust those regulators to keep an eye on the risk, more so than alternatives.
So a quick jump ball for the panel. Yelena talked about the Synapse Evolve debacle. Any thoughts of how the industry, either on the bank or the non-bank side, and how your institutions have thought about the lessons from this, or is it just an aberrant comet going across the sky of no relevance? So, who wants to take that?
I'll take it. So that was a debacle, obviously, and it was crazy that basic reconciliation, that's kind of bread and butter of how banks work, seemed to have not been in place. But what I was sitting next to my pal, John Carlson, who's on the next, and John and I were once young, it's hard to believe, but we once had adjoining offices at the OCC, and we were kibitzing, and I said, wow, so much has happened that already seems like a long time ago to me. Synapse, like every day there's something going on, but it was really good that Yelena brought that back. Like, don't forget, that wasn't that long ago. These are kinds of the risks. And, I would have really liked if the regulators had direct access from the get-go about what was going on there, instead of attenuated through, the Bank Service Company Act so I wouldn't draw any lessons. It used to be that like some big F-up happens on the FinTech side, and then it's like the bank regulators have to draw that tent even closer, right? For a while, FinTech was synonymous in DC with FTX, and then Synapse, I was like, oh, here we go again. Everybody's, kind of going to get tarred with the same brush here. I think there's less of a risk right now. There's more willingness to distinguish among providers and FinTech models.
Well, and I know within our members, it's really interesting, because that was a very big, important issue, maybe even to the level of like a watershed moment. But it also, I think it changed some of the power dynamics that we saw in bank-FinTech partnership relationships. You had, a lot of FinTech companies that were being pushed by venture capital funds, to move very quickly. You had a lot of power kind of in the onboarding process tied to the FinTech company, and not as much tied to the bank. I think that the Synapse crisis, in broad strokes, not necessarily just the record-keeping, aspect, which I think is important in and of itself, but in broad ways, it kind of changed a little bit the power dynamics that were going on and made sure that, especially within direct bank fintech partnerships, which is, separate and apart from a Synapse situation, which is a middleware indirect partnership, those direct partnerships became a lot more focused on, okay, you might not get to the product to market as quickly, but we're going to be making sure that we're doing it the right way. So going back to the maturity angle, I think that had positive impacts upon both the banks and the fintech companies.
I think I'd just add, from more of even the fintech side, I think there's a level of surprise perhaps at the lack of sort of appropriate guardrails and frameworks between this particular partnership. I think for our members, from that perspective, they were just sort of things that you would have expected between, and the communication lines you would have expected, including some of the reporting and other things between the bank and the fintech, is just business as usual. So it was surprising to see, such a failure in the Synapse case.
And Caitlin, do you have anything to add on that one?
No, just echoing agreement and nodding in the background here. This is basic reconciliation work, and the fact that it failed is a huge red flag. And I think the other point is that when banks do risk assessments and bring on new business lines and new customers, all of this is supposed to be tested in advance. So the real question is, why did that testing fail? Because this should have been captured in advance.
Excellent point. Here's a question on another sort of hot topic for the panel. So last week, the FDIC chairman had said that in the proposal to implement the Genius Act, the FDIC had planned to discuss the availability of pass-through deposit insurance coverage to holder of payments stablecoins, where the stablecoin issuer held reserves in a deposit account at an FDIC-insured institution that failed. He noted that the Genius Act makes clear that payment stablecoins are not subject to deposit insurance, but the act was silent on whether pass-through insurance could apply to payment stablecoins. So Chairman Hill had said that treating stablecoin holders as insured depositors, even on a pass-through basis, was inconsistent with the Act's prohibition on payment stablecoins being subject to deposit insurance. Therefore, he said, the FDIC's planning to, their proposal will be that the payment stablecoins subject to the Genius Act not be eligible to deposit insurance. What are your thoughts on turning now to kind of thinking about payment stablecoins and your institutions and organizations' position on that? What do you think the impact that the proposed approach might have on fintechs and their evaluation of whether to pursue a bank or trust charter, or just their general competitive position in the market?
Well, if I'm following Heidi, so I thought Travis Hill's remarks made perfect sense. As you noted, as he noted, under the Genius Act, stable coins are not deposits, so therefore they are not subject to FDIC insurance. So why would pass-through insurance be available? Particularly, I'm not aware, I don't know if the audience is, of stablecoin issuers acting other than as principal, as opposed to agent, right, where the pass-through might be arguable, So that makes sense to me. I think the real question is, the comparison of stablecoin to deposit tokens, right? What deposit tokens, which are deposits, right, which would be FDIC insured and held in banks. Banks, if they fail, would be subject to FDIC resolution, which could mean that, which would mean that depositors are reunited with their funds very promptly, as opposed to the eventuality, perhaps in a stablecoin, where you would have a bankruptcy and you would not have preferred status, protected priority status,
right,
and it could take months to see some part of the money back. So I think that is a clear competitive advantage for banks and for deposit tokens. One other thing I would say about the stablecoin and the pass-through is the whole point of stablecoins is that they are backed by money, or securities, and the Genius Act requires one-to-one backing.
Right.
So why is there also insurance necessary, pass-through or otherwise? I think it's kind of confusing the topics. Not you, but.
Well, but one thing that happens is it really does draw the stablecoin people to put their money in really large banks so they don't have this risk, because this is about the failure of the deposit account that the stablecoin issuer is holding as the reserve for its holders. So there you go, another screwing of community banks.
Okay, I wasn't going to go that far, but
It's true.
Sure,
I'm allowed
Bob.
to say that? That's terrible. Wow. Oh, yeah, sorry. Okay, Caitlin. For FinTechs thinking about either a trust company or depository institution charter, one of those two, does the distinction matter anymore now that OCC trust companies are functionally operating as banks with a lower capital requirement for the same activity? I guess that's sort of an editorial question, but go right ahead.
Sure, and it relates to what I was saying earlier. I think the Fed's action on Kraken suggests that it actually does matter, right? Kraken was the first to apply for a master account that came from a crypto native company, yet it also has Camel scores. And you can draw your own conclusions from those facts. And I actually, back on the Anchorage discussion of an OCC trust company, it's fascinating to look at a trust company having a large dollar amount of risk-weighted assets on its balance sheet. Historically, that just hasn't happened. I actually asked a few people when we were talking about it, what is this supposed to, have you ever seen a trust company with a large dollar value of risk-weighted assets? And it now exists. As of Q4, Q4 2025, it now exists.
And Michele, do you think, and others on the panel too, of course, but I'll start with Michele. Do you think the applicants underestimate the lift involved in becoming a bank?
Some of them surely do. One of the things at Klaros that we urge all of our clients, in fact, we require them to go through a period of bank design work. We start with that. And right now, for some applicants, they don't want to take the time. They are thinking that it's kind of a race to the courthouse. They'll figure it out on the back end. And those are companies we don't want to work with because they're surely going to run into some obstacles later. The first thing, I think there's a little bit of FOMO, or a lot of bit of FOMO, like, oh, people are getting charters, I better get a charter too, even though maybe I'm not ready. With some, there's just a failure to really evaluate whether the squeeze is going to be worth the juice for them, and it'll come as a shock later just how expensive. And I don't mean my fees, which are not cheap, but don't call me if you want a discount. But no, I mean the cost of capitalizing a bank and building, and that's not even it. It's the building of the guts. Right? And what I do encounter with some potential applicants is a little bit of hubris, like they are successfully running a fintech business that has one side of the balance sheet, never really two. And they think, well, I know how to do this. How hard could it be? And it's like, well, it's hard. And there's a lot of infrastructure that you need to be thinking of. So we start with bank design before we even get to license. And then there's a whole build a bank practice that we have too, because we want to make sure that at least for the applicants we're working with, that we're helping support ultimately successful banks. And I think right now some applicants are being very short-sighted, and they're just going like, give me that stamp of approval, OCC. And I'm just like, look, that stamp of approval, that's the starting line. You got to be thinking about, if not the finish line, you should at least be thinking, how are you going to get through to your first full cycle exam?
Maybe the only thing I would add on that, just, sort of seeing some of our members go through this process. We do have a couple of fintechs who admittedly, they work through bank partnerships and offer different products and services, so have some, pass-through oversight from a prudential perspective, federal prudential perspective in that regard. But I think it also probably bears to mention that some of them are also banks outside of the United States as well. So there is some, there is in many cases an understanding of what this is going to entail.
Absolutely.
I think just from my perspective, to bring it out a little bit from in the weeds, I think of, probably the bane of my existence is the politicization of financial services. And chartering is becoming somewhat of a political issue. And I don't think it should, because ultimately, at the end of the day, you have a good process in place that you shouldn't be running to the courthouse ever to try and get a charter. You should be walking, doing your due diligence, and making the right steps. And so, some commitment from, I think, both sides of the aisle as it relates to what do we want to do as it relates to chartering? How do we want to think about, the financial services industry moving forward? That can be really helpful for both industry and then ultimately for the consumers that they serve.
On the Skinny Master Account proposal, you advocated for account choice and Fed ACH offering recommendations to address the Fed's credit risk concerns with expanding to other rails. Can you talk about your members' views and why you think your recommendations sufficiently address the Fed's concerns?
Sure. So I realize we're really switching topics here on everyone. So apologies for that. But, I think, so from our members' perspective, they're very interested in this concept of a skinny master. And really, it's about sort of access to Fed clearing and settlement services, predominantly because a lot of their payment services are through partnerships, and you can lower costs and increase speed by getting a Fed account. And so, we were pleased to see the Fed sort of start the skinny discussion. I think there's a couple of areas that we were concerned about, as I mentioned earlier, which is in particular the lack of access currently to ACH, and a lot of that, according to the Fed's proposal, of course, was due to concerns around credit risk. So at least in our sort of discussions with members and comment letters, we did work to come up with additional sort of concepts that maybe could help get the Fed comfortable with elements of that risk, whether it's sort of collateralization, additional collateralization requirements, maybe interest charges on intraday credit. Obviously, you also could build and enhance some of the supervisory mechanisms, including maybe an automatic sort of stopgap mechanism if an account gets to a certain place. So all of that to say, I think, from a 50,000 point view as we're closing out this session, I think, one of the big things that will make a skinny account useful is going to be the ACH access, just given its volume. And so it's something we hope the Fed will continue to consider.
Great. Well, you know what? I think, why don't we invite anyone up to this, to the mic and ask any questions you have at this point. But while we do that, the BPI, is John Court still here? He left. John has left, okay. Well, the BPI was not happy with the Kansas City Kraken decision, and they said it front runs the board's public comment process. It calls into question whether the board can ensure that the skinny accounts are applied consistently across the reserve banks, and there's no transparency about controls and risk mitigants. Any reaction to the BPI's adverse feeling about this renegade Kansas City action?
Well, I have to say that's one of the rare times that the BPI and I are actually pretty aligned. I was pretty surprised. In fact, the American banker called me the morning of the Kraken announcement and said, "What was your first reaction?" I was like, "Well, can you print holy shit?" And it turns out no.
All right.
But I really want to say my second reaction was to reach out to Caitlin. And Caitlin is personally like a hero of mine. I'm sort of a fangirl for Caitlin. And I think anything that has to do with master account, we should check with Caitlin.
Caitlin, I think you have no choice but to weigh in.
Well, thank you. It's mutual, Michelle. I've been working on this since I remember reading a Bloomberg article about Fourth Corner Credit Union being denied its master account application in 2015. That's when I figured out what master accounts were and started down the path of trying to figure out how to integrate digital assets safely into master accounts, because ultimately, without that, they will stay completely outside the system and frankly could cause real problems for the system. It's better if they are inside and monitored, and the Fed has the ability from a financial stability perspective to have visibility into them. So here we are 11 years later, and finally the logjam is broken. I think it's not clear that what Kraken got is a skinny account. The skinny account, frankly, doesn't exist, precisely because of the reason that you alluded. It's in proposed rules at this point. Again, the thing that so many people have overlooked is that is a full-fledged depository institution examined as such and with Camel scores. And I think that you will see the skinny accounts eventually come to pass. It's pretty clear that the Fed wants to bring this inside the regulatory perimeter, wherever that perimeter is defined right now. We've been obviously working on it for a long, long time. And ultimately, I think it will be better for financial stability that it's inside the system, that this risk is controlled and monitored as opposed to sent into the shadows. I will admit, as I said, I'm up in New York for the American Banker On-Chain Summit today, where we made a big announcement today about Vantage and Custodia with tokenized deposits. This morning, actually, American Banker alluded to it in their LinkedIn post today. They didn't reveal what it was, but what you're seeing now is that regulators who were hostile to it, outright hostile to it, are now coming around that this technology is not going away. It does have to be integrated safely into the system. Custodia is doing tokenized deposits. All of the payment flows are running by necessity, since we don't have our own master account, through Vantage's master account. We are more than a year since our pilots with Vantage, and the Dallas Fed has been with them every 2 weeks all along for the more than a year now. So this is all, there's great visibility from the regulators. The state regulators are heavily involved in this as well. And so there are no surprises. There are 3 regulators at the table for what we're doing with Vantage. It's the Dallas Fed, the Texas Department of Banking, and the Wyoming Division of Banking. And I think the states are starting to acknowledge that there needs to be a state version of these. And when we got the endorsement from the Texas Bankers Association, that was a big tell. That happened about 3 weeks ago.
Super. Well, it sounds like exciting things happening. I think we have one question for the panel.
Do you think we'll get actual skinny master accounts, or do you think they'll just take the current Tier 3 designation and further codify what it is and make that the skinny account?
Maybe I'll start. I don't know if others have strong feelings about this. I think from our perspective, one of the elements we emphasized in our comment letter was that in no way did we want the option of a skinny master account to take away the statutory right to a full master, and sort of make tiers de facto skinny masters. I think, I've heard what Governor Bowman and others have said about, sort of how do you find that path for, tier 3. We do have one tier 3 approval out there, but it's very specific for certain circumstances. So I think the hope is that it's not, and I think the goal is that you have the ability to choose whether you're going the full master way or the skinny master, and then there's a risk, sort of the risk assessment is done.
Yeah, and I'll just say that, similar to Angelina's point, I think we agree a lot in our comment letters, and ultimately there really shouldn't be that sort of mutual exclusivity, because there's certain entities that are going to have subsidiaries that will, need, maybe a skinny account access, and there's certain ones that will, the parent company will need the full account access, and there's benefits to having kind of both in that system. And so we just don't want to see there be kind of a mutual exclusivity between having a full master account and having a skinny account.
Well, thank you so much to our great panelists for, I think, what was a lively discussion. Some of it may have to be scrubbed from the video. Anyway, this was great, and thank you very much. And Heidi, really, we look forward to doing this with you again next year. So if you guys are on board.